Old age security is an important benefit for Canadian retirees, but if you earn too much money in retirement, those old age security benefits can be clawed back from you. And there are circumstances where retirees who are not necessarily of high income can have temporary spikes in their retirement income that might cause their old age security benefits to be clawed back. I ran across a circumstance like this recently, and in today's video, I'm going to explain what the old age security clawback is. I'm going to use an example to illustrate how the old age security clawback works. And I'm going to close the video by sharing some strategies that you can use to help manage your old age security and the old age security clawback in your retirement. And if we haven't met yet, my name is Mark Walhout. I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. So we'll start by talking about what the old age security clawback is and who it applies to. So the old age security benefit is funded by taxpayer dollars. We don't need to pay into the old age security program. So if you're over the age of 65 and you've been a resident of Canada, you are eligible for at least some old age security. And the old age security benefit is really meant as sort of a form of guaranteed income for Canadian retirees. And as such, it's set up as what's called a means tested benefit. So if you earn over a certain amount of money, the government says, you know what, this is really meant to be sort of a level of sustainment type income for retirees. You earn too much money, so we're going to begin to claw back the amount of benefit that you're going to get. And I don't run across a ton of situations where people are seeing old age security clawback. I'm going to share those limits in a minute. But there are circumstances, one of which I did come across recently, where someone has a temporary spike in their income and they will see some of their old age security benefits clawed back. So we'll start by talking about where those thresholds are as of 2023. So I'm sharing my screen right now. This is from the Government of Canada website. But in the year 2023, if an OAS recipient, so if you're over the age of 65 and collecting the old age security benefit, if your income is above $86,912, your old age security benefits begin to be what's called clawed back. And that means for every dollar that you earn over this threshold, 15 cents of every dollar over that threshold is what's called clawed back. It's added in the year of the old age security overage, or the amount of income that you have over the old age security threshold. In the year that that happens, it's treated as a tax. It gets added to your tax bill. And then in future years, assuming that your income remains at that elevated level, your old age security benefits are going to have additional tax withholdings taken from it to anticipate that you're going to continue to be in this old age security clawback zone. Now, again, there aren't many situations that I run across where we have Canadian retirees that are exceeding consistently that $86,912 of annual income for a number of reasons. Number one, it would take a lot of income from your RIF accounts, dividends, interest to create an income that would exceed $86,912 when combined with other sources of retirement income like pensions and old age security and CPP. There just frankly aren't many Canadians that reach that. There are ones that do, but it just isn't a very common scenario. There are other reasons why a lot of people don't exceed those thresholds, because there are other opportunities in retirement. There's more tax efficiency with income sources from things like capital gains, from dividends, and you have income splitting opportunities, income sharing opportunities in retirement that we don't necessarily have while we're working and just earning a paycheck. So it doesn't happen very often, but there are circumstances where mass affluent retirees, would say sort of like average Canadian retirees, might have a temporary spike in their income. And the circumstance that I ran across a couple weeks ago was one where a Canadian retiree had a capital gain through the sale of a property. So they sold a cottage property. They realized a capital gain that pushed them into the old age security clawback zone, is how we call it. So for the next phase of the video, what I'm going to do is I'm going to share an example. I've changed the details of this scenario. This isn't the example that I ran across, but it really does a good job, I believe, of illustrating how this old age security clawback works. And then we'll move from there into some strategies that you can use to manage old age security clawback. So I'm going to go ahead and share my screen again, and we're going to use an example. A retiree, his name's Johnny. He's 68 years old. In 2023, he has the following sources of income. I'm going to make this a little bit larger, but he's going to have $8,000 in old age security benefits. He's going to have $10,000 in Canada Pension Plan benefits. He has $5,000 in Canadian dividends in a taxable or non-registered account. He has $20,000 of withdrawals from his RIF and RSPs. So when you just look at those income sources, those would not put Johnny into the old age security clawback zone. He would not experience any type of clawback on his old age security benefits. The issue for Johnny is that in 2023, he sold a cottage, and on the sale of that cottage, he realized a capital gain of $100,000. And when you total up his income for 2023 after you factor in the sale of the cottage, his net income in 2023 would be $94,900. So how do we get to $94,900? We add up old age security, Canada Pension Plan, his $20,000 in RIF withdrawals. His $5,000 in Canadian dividends is grossed up on his tax return in the section that's calculating total income. It's grossed up by 38%. This video is not about the Canadian dividend gross up, but Canadian dividends, they do cause, for the purposes of the calculation of the old age security clawback, they do cause your income in that calculation to rise. Canadian dividends are what's called grossed up when they hit your income tax return to sort of put you back in the shoes of the corporation before they pay tax on the income that was generated to create the dividend. So when we're calculating where we land as far as the old age security clawback goes, that gross up in Canadian dividends does make a difference in terms of that calculation. And then the capital gain, it does receive preferable tax treatment. So not $100,000 of income that's hitting the tax return in this case for Johnny, but 50% of that gain is added to his income. So when we do that math, that works out to $94,900 of income for Johnny in 2023. And recall that from our previous chart, the old age security clawback threshold for this year is set at $86,912. So what that means is that Johnny has $7,988 of income in 2023 that kind of lands above or goes beyond that old age security threshold. So in order to calculate what Johnny's old age security clawback is going to be, or his recovery tax is going to be, you take that overage amount and you multiply it by 15%. So what that means is that Johnny, when he files his tax return for 2023, I just want to make sure we get all the words in here, is that he's going to have an additional $1,198.20 of income taxes that he has to pay for the 2023 tax year when he files his taxes next spring. And then here's the kicker. This is like the double whammy of the old age security clawback, is that in addition to having to pay a larger tax bill when he files his 2023 tax return, the government looks at Johnny's tax return and says, look, if Johnny had this higher income in 2023, we're going to expect or anticipate that this condition is going to exist into the future. So we're going to start withholding more taxes from Johnny's old age security benefit, anticipating that he's going to continue to be in this clawback zone. So what happens is they take the amount of the old age security recovery tax that Johnny needs to pay in 2023. They divide that number by 12, and then on a monthly basis, while Johnny receives his old age security benefits in 2024 for the year that starts in July 2024 and ends in June 2025, every single month they're going to deduct an additional $99.85 from Johnny's old age security benefit in anticipation that he's going to continue to be in this clawback zone. So you can see how the old age security recovery tax works. We see that if we're over that threshold, we need to pay some additional taxes. Those benefits begin to be clawed back from us. But you can see also how the trouble arises for a retiree whose income only temporarily spikes up into the old age security recovery zone. They now need to pay this additional tax going forward. Now, there are things that you can do to mitigate this. You can file a form that I'm going to include in the show notes. It's called the T1213. And that allows you to basically put in an application with the government that says, look, what happened last year was just an anomaly, or what happened in 2023 was just an anomaly. My income for 2024 is not going to be as high. Please don't withhold as much from my old age security benefits, anticipating that income is going to be repeating. It's not. But the filing of that form does take a couple months to process, so you may still see some clawback of those benefits. The other thing to remember here too is that if in the following year, so in Johnny's case, 2023, he's subject to the old age security recovery tax. In 2024, if his income goes back to what it was previously, and I'm going to go ahead and share my screen, if in 2024, the tax year, everything goes back to being the same as it was before, he just doesn't have this capital gain. We'll just scratch this out. So just assume that his income only includes these sources in 2024, then he's going to be back under that threshold. He doesn't need to worry. So if he's paying that additional withholding, or if more money is being withheld from his old age security benefits, that additional withholding is going to be credited to his 2024 tax return. So if it ends up that he's overpaid his taxes, he will receive that additional withholding back in the form of a tax return, or at very least a credit towards his other income sources in 2024. So we've talked about what the old age security clawback is. I've illustrated how it works in practice. The big circumstance that I did come across is a retiree who had a temporary spike in their income due to a capital gain. So now we'll spend some time talking about what can be done to manage the old age security clawback. And I use this language very intentionally. And we're going to talk at the end about getting wrapped around the axle, which is one of my favorite sayings when we think about, strategies that make sense in retirement and strategies that don't. So the first strategy that you can use or deploy to manage your old age security clawback is delay taking the old age security benefit if you believe that you will consistently be in the old age security clawback zone, or have your old age security benefits fully clawed back. And so I run across this with retirees who are still working beyond the age of 65. If they're earning over that threshold, and maybe they're earning to a point where their old age security benefits are fully going to be clawed back, it just doesn't make sense to apply to get the benefit only to have to turn around and give all that money back to the government in the form of taxes because you are in or beyond that old age security recovery threshold. So the first thing is, if we know that a retiree or someone who's approaching age 65 is going to consistently be in that zone or beyond that zone for the years between 65 and 70, let's at least think about delaying those benefits out. The second one is consider the tax efficiency of your investments in taxable accounts. So we talked about the effect of the gross up process for Canadian dividends. Interest is also fully taxed as income. So if you have money in your retirement accounts that's in taxable accounts, so not RSPs, not tax-free savings accounts, not RIFs, not LIFs, not locked-in RSPs, not tax-sheltered or tax deferral vehicles, if you have money in just regular plain investment accounts that's generating investment income, consider the tax efficiency of the investments in those accounts. So forms of investment income that are most tax efficient are capital gains presently in Canada. So capital gains is only 50% of the gain is added to your taxable income. The other thing to think about when considering the tax efficiency of your investments is turnover. So if you have a non-registered portfolio that's being consistently turned over, so if you own a fund that has a manager that's very, very active, they're processing a lot of purchasing and sell transactions in that account, that can spin up a lot of taxable events in that account, and that might create a situation where it's pushing your investment income up into that threshold consistently. One of the many reasons that I love index funds or highly diversified portfolios that don't turn over a lot is that they don't generate a lot of that tax churn on a year-to-year basis. So to the extent that we can mitigate old age security clawback with tax efficient investments, we want to consider doing that. And then the third strategy is, if the bump up is temporary, consider filing that form, the T1213, and I will include a link in the notes below. I will also include a link to the tax return. Johnny's tax scenario that I talked about above, I actually created a sample tax return using the tax tips calculator. If you're interested in the details of how this all worked out for Johnny, I'll include that so you can check out Johnny's sort of sample tax return. And then the final thing that I've included here is, don't get wrapped around the axle. So I use this metaphor when I talk to people about these strategies in retirement. Sometimes I find that people get so obsessed about avoiding the old age security clawback, they might be inclined to do things that really don't make sense for their retirement plan. And so, they might consider, hey, you know what, I'm going to go ahead and, sell my cottage this year so that I avoid my old age security clawback that I plan to take next year, even though maybe they don't want to sell their cottage, they want to hold on to it. Or they're doing things like rapidly drawing down off of their RSP accounts, generating a lot of taxable income in those years leading up to their old age security claiming age, and strictly to avoid encountering that old age security clawback. Now, don't get me wrong, I think that in certain circumstances, making those changes can benefit your overall plan. But if you're gearing your tactics strictly towards avoiding that OAS clawback to the kind of exclusion of all the other factors in your financial plan, you might be harming yourself or harming your own plan. I think the key here is to sort of consider the impact of old age security in the context of your broader plan, and then using software and good conversation, we can model out the impact of these different decisions. I would say just avoid as much as you can just looking at old age security as like the only objective that you need to protect, that staying out of that clawback zone, avoiding doing things that just don't make sense for your plan just to avoid that clawback. So I hope that makes sense. I call that getting wrapped around the axle, or maybe ignoring the forest for the trees would be another way that someone might sort of talk about that scenario. So anyways, I hope that you find this video, or you found this video to be helpful. Again, I've included Johnny's sample tax return. I've included the 1213 in the description section below. I've included some other resources in the description as well that might help you as you're thinking about your retirement plan. If you have any questions or comments, leave them in the comment section below. I always love getting questions because they give me ideas for videos that I can create in the future. And if you like this video and you've made it all the way to the end, hit that subscribe button so you get more videos pushed to the top of your feed. And hit that like button if you did like this video. It helps these videos get out to other people like you that have these retirement questions so that they can get the benefit of this education. Thanks for watching, and I'll speak with you soon. Take care.